For decades, Maruti Suzuki has been the undisputed king of India's roads. From the iconic Maruti 800 that put India on wheels in the 80s to the 2 million car a year juggernaut it is today, Maruti has ruled the country's passenger vehicle market with unmatched scale, reach, and trust. But even giants face headwinds. Despite selling a car every 13 seconds and holding a commanding 42% market share, Maruti is now battling intensifying competition, shifting buyer preferences, and margin pressures. So what does all of this mean for investors? Welcome to Bottomline by Groww. In today's episode, let's analyze how India's auto titan, Maruti Suzuki, is navigating slowing volumes, rising costs, and a transforming mobility landscape, and whether it can hold its pole position as the road ahead gets tougher. Buckle up. Let's start with the troubles. Is Maruti Suzuki in trouble? While Maruti Suzuki continues to dominate with volumes and reach, its Q4 FY24 performance revealed a few speed bumps that could slow down its momentum if left unaddressed. In Q4 FY25, Maruti Suzuki posted a solid 3.5% YOY volume gain and a 5.9% YOY rise in net sales. But profitability took a hit. Its operating EBIT fell 14.2% YOY. This resulted in PAT declining by 4.3% YOY. Should this be a big worry? Well, if it is combined with macroeconomic factors, then it is a cause for concern. Let's understand better. First, overall industry growth has cooled sharply. India's passenger vehicle market expanded just 2.5% in FY25, down from 8.4% the previous year. This slowdown, especially in the entry-level segment, has hit Maruti's traditional stronghold, where affordability remains challenging. The consumption trend has yet to improve, and if the weak trend continues, it could pressure the company's future performance. Also, rural demand remains muted as well, with nearly 88% of India's population still not owning a car, limiting the upside in first-time buyer volumes. Second, adding to the pressure, the Maruti's ramp-up of the Kharkhoda plant in Haryana increased operating costs. While essential for future growth, these initial overheads weighed on current margins and could continue for quite a few quarters. At the same time, a spike in input costs, particularly steel, further pinched profitability. Though partially offset by safeguard duty relief, the cost structure still took a hit. Further, margins were also impacted by an unforgivable product mix. The share of CNG vehicles dropped from 36.1% in Q3 to 33.7% in Q4. Also, SUVs, once a major growth engine, also slipped from 39.7% to 36.8% during the same period. Even exports, typically a margin-enhancing lever, dipped slightly in Q4, eroding blended profitability. This apart, Maruti dialed up marketing expenses significantly. Auto Expo reveals and high-profile IPL tie-ins meant that ad spend surged. Add to that one-off costs and seasonality spikes from plant maintenance, CSR commitments, and digital infrastructure upgrades. All of that led to total other expenses swelling to 14.6% of revenue. But the most concerning risk is the erosion in market share. Maruti Suzuki's share fell to 41% in FY25, marking a 12-year low from the 50% dominance it enjoyed just a few years ago. That's largely due to fierce competition. Tata Motors, Mahindra and Mahindra, Hyundai-Kia, MG and Toyota have all made big gains, particularly in the SUV and electronic vehicle categories, where consumer preferences are shifting rapidly. And that brings us to a structural issue: Maruti's late entry into the EV race. While rivals are already building scale and brand equity in the electric vehicle segment, Maruti is only expected to debut its first battery EV in the second half of FY26. This delay in tapping into the fast-maturing EV opportunity could make it harder to regain lost ground unless addressed with urgency and agility. Despite strong fundamentals, these headwinds serve as a reality check. The company is taking some strategic initiatives to address these risks and challenges, which could keep Maruti in the driver's seat. Number 1. Maruti Suzuki is going all in on the product pipeline. After unveiling its 4th generation Swift and a redesigned Dzire in FY25, the company is gearing up for 2 major launches in FY26. The much anticipated e-Vitara, its first battery electric SUV, and the new high-volume utility vehicle aimed squarely at India's SUV-hungry market. Beyond that, Maruti plans to expand its portfolio to 28 models by the end of the decade, ensuring there's something for every Indian household, from city hatches to rugged off-roaders. Number 2, to support these product launches, Maruti Suzuki is doubling down on flexible manufacturing, retooling its plants so petrol models, hybrids, and upcoming EVs can all roll off the same assembly lines. Number 3, while domestic growth has shown signs of slowing, Maruti is hitting the accelerator on exports. FY25 saw a record 332,000 units shipped abroad, and the company is eyeing at least 20% YOY export growth in FY26. In fact, the long-term ambition is bold: 750,000 to 800,000 exports annually by FY31, which would represent a strong 15% CAGR. This could become a serious growth engine going forward. Number 4. Maruti, recognizing that India's EV shift will be gradual rather than abrupt, is covering all bases. The company already commands a dominant share of 75% of India's CNG segment, owns nearly 18% of PV sales via its CNG lineup, and is steadily increasing its hybrid mix to 2.4%. Together, this diversified portfolio helps Maruti meet the stringent fuel efficiency norms like CAFE3, while also giving customers a range of cleaner options without burning a hole in their pocket. To support these launches and export targets, Maruti has built 3 world-class plants in Haryana and Gujarat with combined capacity of 2.35 million units annually. Number 5. The company's strong financial position is the biggest advantage. In addition, Maruti is also gearing up to invest 8,000 to 9,000 crores in FY26 capex, fueling its next phase of expansion. This hefty capex push is powered by a 96,083 crore rupee reserve pile as of March 2025, giving it the firepower to absorb headwinds without leaning on debt. That financial muscle not only funds growth but also cushions against headwinds. To give you perspective, the company's profit had seen a steady rise, dipping only during the COVID downturn. But does it mean that the stock is fairly priced, pricing both risk and the prospects? As of May 15, 2025, the stock trades at a PE of 26.6 times, comfortably below its long-term median of 30 times. That's a far cry from the frothy 81.3 times multiple seen back in February 2022, when EV hype and ultra-low interest rates inflated valuations for autos across the board. This current pullback reflects multiple factors: slower industry growth, margin pressures from new plant ramp-ups, and input cost inflation, as well as the company's heavy capex cycle. But for long-term investors, that sub-median valuation could offer a built-in cushion. As of 15 May 2025, Maruti Suzuki's market capitalization stands at 3.98 lakh crores, which puts the value of parent Suzuki Motor Corporation's stake, which is 58.28%, at a whopping 2.3 lakh crore rupees. So Suzuki's entire global market cap is just 2.02 lakh crore rupees, meaning Maruti's stake alone is worth more than Suzuki itself. This stark valuation gap raises important questions around Suzuki's global investor perception versus Maruti's franchise value in India. Some might even argue that the Indian arm has outgrown its parent. While Maruti Suzuki may appear fairly valued on paper, the bigger question is, what premiums are you paying for its promise? Are we seeing a company, the face of Indian automotive sector, struggling to defend its turf in a rapidly changing market? Or a company that is getting ready for the next phase of growth? Leave your thoughts in the comments section. For more such insights, subscribe to Bottomline by Groww.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.